Hello and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today is November 27th, 2025, and we're taking a deep dive into the AUDUSD currency pair. We have a lot to cover, from significant fundamental news to a multi-timeframe technical breakdown. First, let's discuss the current events shaping the market sentiment. The biggest story right now is the shifting tone from the U.S. Federal Reserve. Dovish comments from key officials like New York Fed President John Williams and Fed Governor Christopher Waller have dramatically increased the odds of a December rate cut to around 80%. This potential for Fed easing is putting significant pressure on the US dollar. Meanwhile, the Reserve Bank of Australia is telling a different story. The RBA is holding its cash rate steady at 3.6%, citing concerns over sticky inflation, which recently hit a 17-month high of 3.8% year-over-year. This creates a clear monetary policy divergence, with a hawkish RBA contrasting a newly dovish Fed, which is fundamentally supportive for the Aussie dollar in the short term. However, looking further ahead, many experts predict this same divergence will eventually push AUDUSD towards record lows as the interest rate differential widens in favor of Australia. Adding to the complexity is the upcoming Australian monthly trimmed mean CPI data, a critical inflation reading. A strong number could further limit the chances of any RBA rate cuts and boost the Aussie, while a weak number could bring those cut expectations back into play. The market is essentially in a state of consolidation, balancing the immediate support from dovish Fed talk against longer-term headwinds and uncertainty around key data. Now, let's transition to the charts to see how this news is reflected in the price action. Looking at the full daily chart for AUDUSD, we can see the broader context of the market. After peaking near 0.69 back in late September 2024, the pair entered a prolonged downtrend, eventually finding a bottom earlier this year. From that low, a recovery began, forming what some analysts have called a 7-month uptrend channel. However, price action has been volatile. We saw a peak at the end of October near 0.6617, followed by a sharp sell-off throughout the first half of November. This sell-off brought the price down to a critical support zone between 0.6440 and 0.6420. This area has acted as a floor for the market since early August, and as we can see, it held firm once again last week. The bounce from this support level has been significant and directly correlates with the timing of the dovish Fed commentary we just discussed. Over the last 3 trading sessions, we've seen a decisive move to the upside. Today's candle is particularly strong, showing a clear break and hold above the psychological 0.6500 level. This move has also pushed the price above what was the 200-day moving average, a bullish signal for many traders. The immediate challenge for bulls is now to reclaim the previous uptrend channel by clearing resistance around the 0.6485 area, which it appears to be doing now. Let's zoom in on the daily chart to get a clearer picture of this recent reversal. Here we can see the bearish engulfing week that was mentioned in reports, which marked the worst week for the Aussie in 6. Following that sharp decline, the price found its footing right at that 0.6420 support level, forming a base over several days. The subsequent rally has been impressive, with 3 consecutive bullish days. This price action suggests that buying pressure is stepping in, fueled by the changing Fed outlook. The next key resistance level to watch on this time frame is the November high, which sits around 0.6580. A break above that level would be a very strong confirmation of a continued bullish trend. Conversely, if this momentum fades, the 0.6500 level now becomes the first line of support to watch. Switching over to the 1-hour chart, we can analyze the structure of this recent rally. The move up from the lows below 0.6450 has been structured with a series of higher highs and higher lows, a classic sign of an uptrend. We can see a strong impulsive wave that broke through the 0.6500 barrier earlier today. Since that break, the price has been consolidating in a tight range, building energy for its next potential move. This consolidation above a key broken level is typically a bullish continuation pattern. For intraday traders, the bottom of this current range around 0.6510 acts as immediate support. As long as the price remains above this level on the hourly chart, the short-term bias remains to the upside. A break below this could signal a temporary pullback, perhaps to retest the 0.6500 level from above. Finally, let's drill down to the 15-minute chart to look at today's price action in detail. Here we can clearly see the explosive move that occurred early in the session, taking the price from the 0.6470s all the way up to the 0.6520s. Following this sharp rally, volume has tapered off, and the price has entered a sideways channel, which is healthy after such a strong move. This suggests the market is absorbing the recent gains and waiting for the next catalyst. For very short-term scalpers, trading the boundaries of this range could be a strategy. The support of this range is around 0.6515, and the resistance is near 0.6525. A breakout above this range would signal a continuation of the bullish momentum, while a breakdown below would point to a deeper intraday correction. So, to recap everything on the daily chart, let's outline the key levels and potential scenarios. Your major support zone remains at 0.6440 down to 0.6420. A break below this would be very bearish. The new psychological and short-term support level is now at 0.6500. On the upside, immediate resistance is the recent high around 0.6527, followed by the more significant November high at 0.6580, and then the October top near 0.6629. Now for our unbiased predictions. The bullish scenario, which I see as having a 65% likelihood in the short term, is that the price holds above 0.6500. Fueled by Fed rate cut hopes and potentially a firm Australian CPI print, we would look for a move to test 0.6580. A daily close above that level would reinforce this view and open the path towards 0.6630. The bearish scenario, with a 35% likelihood, would involve a failure to hold the 0.6500 support. This could be triggered by a soft CPI number or a sudden shift in Fed sentiment. This would likely lead to a retest of the critical 0.6440 to 0.6420 support zone. A confirmed break and close below that zone would invalidate the current bullish structure and signal a much deeper correction, possibly targeting 0.6300. The main thing to watch is the upcoming Australian CPI data, as it could be the catalyst that breaks the price out of its current consolidation. Thank you for watching this analysis on Explain the Charts. Please remember, this is for educational purposes only and is not financial advice. Always conduct your own thorough research before making any investment decisions.